Hey, welcome back to the Mining Pod. On today's show, we are joined by Adam Back. He is the CEO and co-founder of Blockstream. They are a very well-known Bitcoin company that originally was created to work on sidechains for Bitcoin. And now they have everything from Lightning to Bitcoin mining to a wallet and everything in between. We're here to talk about their new BMN2 note, which is basically a different way of getting exposure to hash rate. They produced a BMN one note a few years ago. It did pretty well, and now they're doubling down and doing it again. So we brought on Adam to talk about this note, how it works, the numbers behind it, how it works in the current mining landscape, and much more. Thanks for sticking around with us. If you enjoy the content, go check out blockspace.media. Go check out the Mining Pod newsletter. You can subscribe to that at miningpod.blockspace.media. Or just look in today's show notes. Okay, a few words from our advertisers, and then on to the show.
Accelerated by Compass is the premier accelerator program for Bitcoin mining sites at any stage of development. Our managed services provide expert guidance in site procurement, construction, energy agreements, and mining operations. Compass helps clients meet timelines and expectations for operational excellence, from greenfield to retrofits and everything in between. Don't just mine, excel. Visit compassmining.io now to discover how Accelerated by Compass can power your success.
Are you a retail or institutional investor interested in Bitcoin mining companies? The Miner Mag brings you free data and analysis from all major NASDAQ-listed Bitcoin mining operations to know who stands out. Check out visualized metrics and data-dependent stories at theminermag.com. Hey, welcome back to the Mining Pod. We are joined by Blockstream's Adam Back today, and of course, Colin Harper of BlockSpace.media. Welcome, gents, to the show. How are you guys doing today?
Doing great.
Good.
Awesome. Well, we're excited to have Blockstream on. I don't think we've ever had Blockstream on the show, which has been a huge miss for us so far because you guys have a very large private mining operation, and you guys are also putting out some interesting new financial products. So we're going to dive into this and that and the other thing on today's show. Adam, we'll just kind of start off talking about Blockstream as a Bitcoin miner. And when Blockstream kind of started back in like 2014, 2015, you guys were, the sidechain company, and then you guys developed the wallet. And now I think most people know you guys as sort of like a Lightning house, like building that stuff out, and then mining. Definitely have like a very large mining operation going on. So let's take a step back and talk about Blockstream for a moment and talk about the mining operation after that.
So Blockstream was started in 2014. The initial concept they wanted to build was the sidechain concept, which became Liquid, the Liquid network, kind of layer 2 that supports Bitcoin, of course, but also other assets like stablecoins and shares. And the topic of today's conversation, the BMN2 and the BMN1 before it, are security tokens or real-world asset tokens on a Liquid network, as well as, a financial instrument. So that's one thing that Blockstream does. It has a foot in a few Bitcoin layer 2 things. One is Liquid, and after we started working on that, Lightning was published, and we recruited some people to work on what's now called Core Lightning, so one of the major Lightning implementations, including Christian Decker, Rusty Russell, the initial 2 people on that project some years ago. I think we were the first live Lightning store selling things for real value back in the days. And, it was kind of reckless as a sort of comment became, because it was live while it was beta kind of thing, and there's real money involved. And so we have a number of things related to Liquid, like a hardware wallet, which is Bitcoin and Liquid capable. It's called Jade. We have a block explorer, and some of the other block explorers are using our open source kind of code base to add functionality to their block explorers. So it's kind of reused code base as well. And then, of course, we're in mining. So we've been mining for a while, kind of mixture of prop mining, mining for the company or for kind of our investor, like one of our investors initially, Reid Hoffman. And then after that, we expanded into providing hosting for third parties. So we have Fidelity's miners and some other brands that people would have heard of. Not all of them are public, but many of them don't necessarily have physical infrastructure. So we hosted their equipment. And then, as we were in the media where people were talking about us hosting, Fidelity's miners, Reid Hoffman's miners, we got a lot of inbound interest from individuals who want to, host miners. And to make it simpler, we figured we should sort of standardize it and make it into a security, because, it creates a lot of costs and support if you have, thousands of users with, 1, 2, 3, 4 miners each. They get support tickets, one of the miners is down. So some of the companies are doing that. But we figured our existing user base at that point was like, a dozen or so, but large clients, right? High net worth individuals or various public or private funds that are doing mining in large scale. We effectively combined lots of users into what looks like an enterprise sale to us, but is a tradable security to the user. And that means there's not really a support cost because the mining performance is standardized across, all the current owners of the BMN node. So, if one machine goes down, they're not really going to notice. There was a 10% overage in the first one, so sort of spare machines for a hot swap for equipment failure. We're able to do that because we are mining for ourselves too. So I think the BMN one, which matured as a 3-year product that matured in July this year, it delivered all the hash rate, right? There was no kind of experienced outage because of that overage. And that product, we can talk about the performance of that product. It worked out quite well. The China mining ban gave it a boost because the hash rate dropped. And, there's another topic with Bitcoin mining is if you invest, if you buy your mining contract or mining product like this, if you do it with Bitcoin or if you do it with dollars, because that can have different outcomes, right? If you do it with dollars, you also benefit from Bitcoin price going up. If you do it with Bitcoin, the target is, do you get more Bitcoin out than you put in? And with BMN1, that turns out to be the case. So the average, I think, is about 32% Bitcoin return. So, if somebody put in 10 Bitcoin, they got 13.2 Bitcoin out, minus kind of administration fees. So that was a pretty good result for BMN1. And the inputs to BMN2, which are in market at the moment, people are investing in different series of it. So we sell it into the market in stages. And so there's Series 1 that's out, Series 2, and Series 3 is in the market. And those are standardized, fungible. It doesn't matter, as a holder, whether you own Series 1 or Series 2, they are financially equivalent. Now, you might pay a different price for them because it's ultimately dependent on Bitcoin hash rate and Bitcoin price and things like that. But once you have it, they're interchangeable. And that helps to make a market. So BMN1 was tradable. So you get a token in a wallet. It feels a lot like Bitcoin once you have it there. And you can transfer it to somebody. You can trade it on a trading platform like SideSwap. And the BMN1, which is a kind of non-custodial trading platform, and BMN1 is also tradable on Bitfinex Securities and Merge, which is a Seychelles stock exchange that's itself quite into Bitcoin and offers Bitcoin on their exchange platform.
Just to take a step back, I'm curious about the Blockstream operations for mining. So I know you guys have publicized that you have operations in Quebec. Obviously, the operations in Texas as well, which has been some announcements about that in the past. And then there was some stuff you guys had in Georgia. Tell me a little bit about the operation. It seems to be mostly North American. That's what's advertised within the marketing information for this BMN2 note, and I believe for the BMN1 note. So I'd be curious to know about the geographic spots for your guys' mining operations, and then also maybe some like energy profile info. You guys touted the green energy for this note, and then I'd like to know if you guys have any cost information, like average rates, those sort of things, as much as you can publicize, of course.
It is all North American. We consider further geographic redundancy for the future, but that's the case at the moment. Primarily in Texas and also Montreal and the state of Georgia. So most of the activity is in Texas, but where we put these miners could change because the product is for a hash rate contract. So as long as you get the 1 petahash a day, it doesn't economically affect things for you as as a holder of the node, whether some of the miners are in Montreal, Canada, or Texas or Georgia, right? So then we don't really disclose kind of internal power costs, but this product is quite aggressively priced. There are a couple of ways to price the products, and actually historically what we did with the BMN1 was we just looked at it as an institutional sale, right? So we looked at what are hosting rates at that point in time and what are the cost of the miners, sort of more like on an input cost plus a margin kind of point of view. And of course, once the product starts trading, things can diverge, right? Then it's what is the market value? The BMN1 was a 3-year hash rate contract. What does it value that at? And after a year, then maybe it's got a couple of Bitcoin in it and 2 years of mining left, right? And so people are basically valuing it based on their estimate of how many Bitcoin it will mine to maturity. That's one thing, and then price it in Bitcoin. Like the side swap market is always priced in Bitcoin, and that ended up mining about 7.95 Bitcoin per node, and the costs were ranging between like 4.6 Bitcoin, 6.5 Bitcoin. There were 8 tranches and all the different prices, and there's a euro price as well. You can look at. So the upshot of all that is that the market sets the price ultimately, and once it's running and there's a market, which will be faster start in BMN2 because with BMN1 there wasn't initially a market for a while, and SideSwap appeared partway through, so that developed a bit later. But here there's a SideSwap market from the start. So then. And the other thing with BMN1 is the hash price concept wasn't really developed. The idea of looking at hash rate as the dollar value or the Bitcoin value that it mines per hash per day, which is currently in the region of $40. Of course, it's moving around as the Bitcoin price changes. It's a real time metric, right, that you can calculate independently. And actually, we could pull that up because. Show the historic hash price. So, as you can see there, on the blue line, the dark blue line, this might be a day or two old, but it was around $40 per petahash day. So, in other words, 1 petahash worth of miners, 1,000 terahash worth of miners, would mine about $40 worth of Bitcoin in a day, and the BMN2 is priced more on kind of the input costs, and it's an attractive price for the first for the early series before the market starts. So it's $31,000 for the contract, which translates into around $21 per hash day. So you can see that, and that's why that orange line is below the blue line, and it's a simple way to calculate the conversion between the BMN price and the hash price, which is just divided by 4 years. So divided by 365, divided by 4, you go from 31,000 for a product down to $21 a day. And you can see that, at least on a dollar basis, in the last 5 years about of hash price history, that's a very low price, right? Generally it's been $50 or above in a $50, $60 in a bear market, and $100 above for a lot of the time in a more bullish period, and went all the way up to 400. So it's an interesting interplay because, of course, what it's actually mining per day is Bitcoin, and as a Bitcoin investor, you're going to care about the Bitcoin return. But I would say that the comparable inputs and backtesting for this are quite similar to the BMN1. So depending on what happens in the market in terms of the hash rate, Bitcoin price, and hash price, there's a similar kind of setup. So potential for a similar return to the BMN1, which was quite an attractive return. It's quite difficult to anything that outperforms Bitcoin, and this ended up doing that quite well in the BMN one.
So just really quickly, Adam, I want to back up and just contextualize a lot of this, because I think for some of our listeners, the financialization aspects of this are going to kind of go over their heads, not because they're stupid or anything, but because this is kind of a complicated instrument. So basically for the Blockstream mining node, and just correct me if I'm wrong, you have investors purchasing a token, a security token that represents a petahash worth of hash rate. And this token has basically a duration. This one is, I think, 48 months? Is that correct?
That's right, yeah.
And the first one was 36 or
36, yeah.
Yeah, 36. Okay. So you're purchasing this token, and you're entitled to the rewards outlined under the investment contract for that duration. And then you reap those rewards at the end of once the duration is fully vested. Is that correct?
Right. And I think the other twist with this, so most hash rate contracts are shorter. 6 months is a kind of typical duration. I think some people are starting to offer on request 12 months.
Yeah, Luxor has 12 now.
Yeah, exactly. And then the other point is that this has a market, so it's a tradable, kind of fungible, standardized instrument. With the BMN one, about 50% of the raised, of the notes traded during the lifetime. So there was like reasonably active trading. And so the point is, if you buy a hash rate contract, it's a private contract. You can't easily sell it. There's not really a standard market to sell it. Whereas here, if you're 1 or 2 years in and you decide you want to use the money for something else, or you like this time in the market, you think it's overpriced, you could sell it. Subject to the market.
So this is an important point I wanted to highlight, and this was actually one of my questions, but you answered it early on. So secondary markets for these things have emerged, is what you're saying, right. And they can be traded between accredited investors who have the ability to swap these tokens between their wallets. And this is you kind of said it just there, but I want to highlight that point that with other hash rate contracts, forwards or other futures. The futures, actually, this is different now because Luxor has futures on Binomial. But for the forwards, when you lock in that hash price, you have no ability to liquidate that position. But here you have the ability to actually liquidate it. So the price that Blockstream offers for the notes are set. But then in the secondary markets, you have price discovery for these contracts as people start looking at what they're earning from the Blockstream mining note versus what hash price is returning, correct?
I mean, I think loosely, there's a Telegram channel called Blockstream Finance, and the people that are, interested in mining and, the community of people who invested in this product or trading it develop price models and, discussing what it should be worth. And it generally comes down to, how many Bitcoin do they estimate it will mine if they're looking at the Bitcoin price, right? Because bear in mind, many of these investors bought using Bitcoin itself. And on a dollar basis, now we do have some investors who invested with dollars, then it's you're looking at, it's hard to project what its terminal dollar value will be because that depends on the Bitcoin price at maturity, which nobody knows, right? And of course, the mining outcome becomes more predictable the closer you get to maturity. So the hash rate tends to go up, so you mine a lot more Bitcoin in the first year than the second year, third year, fourth year, right? And there's less time left. So, the movement of the hash price, there's less time for it to move. So it gets more predictable towards the end. So I think most of the trading volume was in the first couple of years with the first 3-year product, because as it got towards the third year, it was basically, let's say 6.9 Bitcoin, and people were guessing, is it going to mine between, 7.5 and 8.5? And so that kind of placed a band around what it could plausibly do. And so there wasn't so much incentive to sell it. And it's like, okay, well, it's going to do about this, I'll just hold it. Right? So people turn more into holders at that point.
Makes sense. It's kind of similar to what we see in futures markets. As a futures contract expires, trading slows down, price converges on a single point because you have fewer trading days in the contract. So you basically know what it's going to be at the end of the duration. Last question out of my trio of questions here, and then I'll kind of kick it back to Will. But you mentioned earlier in the conversation that this was designed as a way to reduce friction for people who wanted to invest in Blockstream's mining business. It's a pain in the ass to have to deal with investors who have however many machines, maybe a few dozen. They're going down sometimes. They have all of these questions. And this reduces the friction for them. It boils it down to something that's a little more digestible that they can understand. What would you say, if any, is the typical investor profile of a Blockstream mining node?
Well, I think that the average, and of course, it varies, was around the $300,000 or $400,000 mark. Yeah, so maybe about 8 or 9 Bitcoin average. Now, of course, there were some larger investors, some smaller investors.
Right. To clarify, though, are we talking about specifically individual accredited investors, funds, a mixed bag?
Oh, the type. Yeah.
Yeah.
Yeah, I mean, there's definitely a mixture. There were some brand recognizable funds that bought it, as part of their kind of fund management, an asset in their fund. There's some family offices and a fair number of Bitcoiners. And I think, with the Series 1, the regulations made things a bit more lumpy. So that's become more flexible in Series 2 with this BMN2. So there was a primary offering, and the Series 3 is a primary offering, right? But during the BMN1 days, which is back to 2021, there was a minimum investment of, it was like 125,000 euros. And so that was too big of a ticket for some people. And so there were people buying in the primary and they're reselling in the secondary. And in the secondary markets, and this is an EU regulatory system, you could buy it as the minimum was 1/100th of a note. So there were people buying in the primary and selling in the secondary. So that creates some of the turnover. But with the Series 2, it depends a bit, which jurisdiction. But there's a possibility to buy in the primary even $10,000, depending on how you fit into the EU accreditation process. So that's one factor. So there were definitely people buying, 0.01 BMN on a secondary, or buying them up over time, that kind of thing. So right. I think the other thing that's changed between, that's new now with BMN2 is there are more hash rate contracts in general. So you mentioned there are some people who broker hash rate contracts, which are provided ultimately by mining companies, and they'll sell a certain amount of contract, maybe to hedge something. And there are people in the middle who kind of sort of act as the broker to get that done, and maybe de-risk it a bit, like do some of the analysis of the seller, and then there are the new things that you mentioned, which is the kind of derivatives, right? So actual futures that are non-physical futures, I presume. So that opens up, makes it easier to arbitrage the BMN2. So for example, if the future duration stretches out to a year, let's say the BMN2 gets to 3 years, you could, directly arbitrage it, right? Because you could sell that. And at that point, the BMN2 would have a certain amount of Bitcoin in it. And, when there's 1 year left, the bit that's left is effectively the same as the 1 year futures on a pair hash, right? And, it's a little more complicated, but you could arbitrage it in the middle. If you think the BMN2 is underpriced, you could buy the BMN2 and sell a hash rate contract, for example, things like that. So especially if it's non-physical, right? Because that's just an instrument that you can short it effectively. So I think that might help with price discovery. I think the other interesting thing is to look at the difference between what institutional miners are paying for hash rate contracts and what Bitcoin basis investors will pay. So I think that can be a source for some two different types of investors who look at things, one on a dollar basis, one on a Bitcoin basis, and part of so it took us a while to try and figure this out, like why are they willing to pay different prices with the BMN1, just empirically in terms of what people are paying for institutional hosting. And what we concluded is that doing mining gives you some downside protection. It's got some dollar cost averaging. If Bitcoin price falls, the hash rate will fall. You mine more Bitcoin, that will partly offset the price fall. And so, for a company or a fund that is doing mining, I think they're placing a value on that. It's kind of like a 3-year put option on Bitcoin or something, right? And of course, you can't buy those because all the Bitcoin options are like 1 year maximum. So they're placing a value on it, whereas the Bitcoin-based investors, they don't care what happens to the Bitcoin price. They just want more Bitcoin, right? And so that's how you can have a price discrepancy. And so I think, the fact that it's now easier to do arbitrage using futures could help keep those two markets together, which
them a little bit
for both parties, right?
Right. Yeah. There's more liquidity across all of these different mining derivatives now, so you're going to have the ability to converge on a single price for these things, as long as they're traders, right? Yeah, and so ultimately they're interchangeable. So now the other thing that's different about this product to what some people are using in terms of hosting is that they'll buy a miner or a few miners, they'll sign up for a hosting package, and then they'll be paying the hosting bill every month. And typically they will sell some of the Bitcoin to cover the hosting bill. So we don't actually sell any Bitcoin. So, and the reason is because we've been in prop mining for a while, we found out from experience that it's better to keep all the Bitcoin you mine. So let's say you've got a budget of $100,000 and you want to do some mining for like 3 or 4 years, for a cycle. If you spend all $100,000 on miners and then you sell enough of the Bitcoin to pay the power bill, the market's cyclical. So in a bear market period, you'll be selling, a big percentage of the coins you mined to pay the monthly power bill. And yet the bear market is when you're mining most of the Bitcoins. So ultimately, we think it's better to, let's say, spend $50,000 on mining and set aside the other 50,000 to pay the power bills, and then keep all the Bitcoin. So our backtesting suggests that you end up with more Bitcoin doing that. And that's so we structured the BMN like that. So it's a kind of lump sum investment. You buy the instrument, of course you can trade it, but it's not selling Bitcoin to cover power bills, which many products are doing.
In the competitive world of Bitcoin mining, one name stands out: CleanSpark, America's Bitcoin miner. At CleanSpark, efficiency isn't just a goal, it's our standard. Our sophisticated facilities are built and led by expert teams who care about Bitcoin and the communities we work in. Scale, we've mastered it. Our large-scale operations have set us apart in the industry as examples of community-oriented building. Our track record speaks for itself. We navigate the complexities of the new economy with precision and with skill, continuously achieving operational milestones. Curious about how we do it? We invite you to discover the story behind CleanSpark's success at cleanspark.com.
This makes sense from the investor standpoint that you're kind of walking out. There's a bunch of different investors that might find this interesting, put the cash up front. You guys run the operation for 4 years. The economics look pretty solid. But I am wondering from a Bitcoin mining perspective, as you guys being operators, why would you guys pursue this versus self-mining, pursuing an IPO, pursuing something else within the mining landscape? And there's a whole host of other things you guys could do, but instead you're, doubling down on this structured note and building another one of them. Is it just the ability to have a different customer base is kind of attractive to you guys? Do you like this, the ability to hedge your hash rate by bringing in new investors and different capital? What is it about this sort of structure for you guys as Bitcoin miners that you think is sort of like your alpha or your game here?
Yeah, I mean, I should also mention it's different from, buying shares in a public mining company, right? Because you don't have an ownership in the company, which then depends on, how much dilution there is from shareholders and how they manage treasury, and ultimately when they decide to reinvest and what to do with the money, right? So this is just a kind of bare bones hash rate contract with a low, the overhead is just regulatory filings, audit, that kind of thing, right? So now the reason we do it is, initially it was because we were in the hosting business, so providing hosting, and this was, to us, another enterprise hosting customer, right? And I think one of the interesting things is that the BMN, like the Bitcoin basis, BMN buyers will, what they will pay at different times in the cycle is different to what the enterprises will pay. So, the big hosting customers. So ultimately, we can sell to whoever is paying more. So if Bitcoin price is high, people will pay more for a BMN because it's, it's a long-term hash rate contract. Generally speaking, I think the other thing I should mention in terms of hash rate contracts, a couple of ways to price them. One is how many Bitcoin is it mined, how much is left on the hash rate, how many Bitcoin do you expect it to accumulate total. And the other way, which is on a very short-term hash rate contracts on a two-week basis, the price of a hash rate contract is basically the price of the Bitcoin it would mine in a 2-week period, which is mostly fixed, right? Because the difficulty won't adjust. And even the 6-month contracts are very closely matching, 180 days times today's hash price, maybe plus a small premium or discount, right? So it's interesting to watch the market sort of deal with these two different views. So, for us, it's a hosting customer, and we do prop mining as well. So we're doing both. There's a bit of diversification as well. It's good to have different customers because, in some markets, somebody's looking at things on a Bitcoin basis when the Bitcoin price is high, that makes the hash rate contract look cheap to them. So they would buy, more BMN because the price in Bitcoin is low compared to what it could mine, let's say, right? So that can be different to the US dollar investment thesis.
So a quick question regarding the payout of these things. We've talked about hash price. Most of our listeners will probably be very aware of hash price. It's denoting Bitcoin mining rewards for specifically FPPS pools and their miners. But it's a way to measure how much you can expect to earn for your hash rate over a given amount of time and for a given quantity. So when you're selling these notes to investors, there's an asking price for it, and they buy it for that asking price. How does Blockstream generate a return from this? Is there a spread that y'all take based on how much is paid out to the miner versus what they pay? I'm just trying to understand the monetization model here, and whether or not there are times in which, purchasing this, the miner is obviously, or the token holder is getting a return for this, but there are times when Blockstream conceivably is mining above the petahash per day, the dollar per petahash per day value of the note, correct?
Yeah, so to us, it's a hosting customer. So we might make a margin the same way we would with Fidelity, which is, like our power plus operating cost is X, and they're paying us X plus some margin, right? And of course, that is partly because you've got operating costs, your business trying to make money, but also because you've got capital deployed to build the infrastructure. So, everybody is generally comfortable doing that because, for example, some of the public mining companies don't have physical infrastructure and they're paying hosting companies to do it. So it's kind of specialization, and others have a bit of both. So they're starting to build their own data center so that they can, make that profit margin, but then it uses up capital, right, which they could otherwise use to buy miners. So it's a trade-off. It's not necessarily clear which will work out best for a public mining company to do it all in-house or outsource physical management. Somebody that specializes in that. So that's our model. It's a enterprise hosting contract, but we do like prop mining too. We did pretty well out of that historically.
Well, and with these notes, they're potentially a way for basically, this is what you're doing. You're selling hash rate forward, and you can then take that. You can take those payouts, and you can take the investments in the Bitcoin mining note and potentially put it towards your prop mining. I'm not saying y'all are doing that, but it gives you optionality to take that cash and then invest it in either more ASICs, more energy infrastructure, things like that. Maybe I'm just totally...
No, generally what...
your treasury management if I was involved in it.
Yeah, generally what we've been doing is first challenge by the miners, right? So that's kind of upfront cost, and then manage the dollar investment, the remaining dollars after buying the miners to finance and cover the cost of the power bills. I mean, your biggest ingredient is your power bills, and then the next is probably like operations, staff, and things like that. Right? So that's basically it. So it's not like financial engineering on the back end. It's like physical operations, basically.
Yeah, I don't want to imply that it is that. I mean, you're providing a service and you're providing exposure to hash rate for those who otherwise don't have any access to it or don't want to build out the infrastructure themselves. So,
yeah. I mean, I think the other thing is the Bitcoin market is kind of unique in being extremely open, right? It's anybody can mine. Individuals can buy a miner, put it in their garage, maybe get a voltage, get a 250 volt outlet, look at how many amps they have in the house, look at their power bill, and then they don't have any operations costs. They get the benefits, right? But the downsides of that are residential power rates can be high compared to bulk data center rates. So you kind of get economies of scale there and negotiating advantages. The other challenge is if you only have a few miners and one of them breaks and you have to send it back to be repaired, you'll suffer a significant temporary drop, right? Whereas in a data center context, we have tens of thousands of them. So if one fails, we just hot swap it, and continue, right? So you get kind of lower friction in that point of view.
One thing I want to talk about within this is the 4-year period, right? So people are kind of like locked into that unless they trade it away. You guys have this 4-year period that you have to honor. How does that work within the context of a Bitcoin mining cycle? I mean, for the last BMN1 note, you guys had a really good timing and it ended up with a nice margin for everyone who participated. But I'd also say that like the last 3 years has been a really interesting time in Bitcoin mining, and who knows what's going to happen this next cycle. So I'm wondering about some inputs here. Costs of purchasing units on the front end, if you guys are going to go ahead and purchase S21s or newer generation units. And then talking about the energy inputs as well, as we're seeing sites in Quebec, Texas, elsewhere that you guys have kind of mentioned, those are more in the 3.5 to 4 cent range at this point. And so those costs are getting a little squeezed, and they're only going to be squeezed more so as people jump into those jurisdictions. So yeah, just to summarize the question, I'd be interested in knowing like how you guys are controlling costs now to make this product work over the next 4 years for you guys as a miner.
Yeah, I mean, we have like pretty good power rates. We participate in some loads, like dynamic loads schemes, which improve your power rate. We have actually two suppliers. One is wind and the other is the grid. And so it's actually, I mean, you mentioned at the top the energy mix. And so, we have hydro in Canada. But that province, the Quebec province, is all hydro. They have 65 hydro dams, so that's very, very high ratio of hydropower, basically. And then the Texas situation is a mixture of wind and grid, and the grid has its own makeup. And then we have Georgia. So between those power sources, our internal average is in the 80% range. Because we have extra miners that we're prop mining. We can do what's called load balancing. So if you turn off the miners during peak power, there's dynamic pricing that we're exposed to. We can reduce the electricity bills, like the average cost per kilowatt hour, significantly. So, even a few percent powered off, peak times makes a big difference on a kind of annual average basis. And then we have extra miners, so we can, maybe we'll use 1.05 petahash of miners to deliver 1 petahash of hash rate, and then we can do it at a lower cost. So that's one thing we do, and that's, that can adapt, basically. And of course, you've also got to look at, profitability, right? If Bitcoin is in a highly profitable phase, people are looking to overclock. And if it's in a low phase, they're looking to underclock or do bigger curtailment. which I say is the case at the moment, right? The hash price is historically low right now. So, yeah, I mean, in terms of our cost profile, our costs are pretty good. I believe some of the material mentions an implied kind of operating cost all in of about 4.5 cents equivalent. If you look at it and try to reverse engineer it from the outside, right, you've got the price, you've got the hash rate, you can look at machine efficiency and say, oh, it sounds like they might be in the 4.5 cents, including power and operations, which is, that's generally I'd say that's a good price. If you look around for, any of the mining services where you can send them a miner, it's probably going to be in a 6 to 7 cents range, maybe 7.5 pence, and it'll depend on the term and so on. So it's a pretty good rate, but then we have the 4-year period to work with, so that cuts both ways, right? Typically, if you are a hosting customer and the hosting companies expect the hash price to go up, that will generally give them the negotiating position to increase the hosting rate. And so, if you go to a hosting company now and say, oh, I want, a 2-year contract, they'll say, no, we can give you 6 months, because they'll cut you a deal for 6 months because they know it's not very profitable. But then they think, well, next year the price will be higher. We can increase it by a cent a kilowatt hour or something, right? So this is kind of negotiation. So if they think the hash price is going to drop, they'll try and lock the buyer into a longer term contract. So there's just a kind of negotiation between the buyers and sellers, and yeah, so it just varies, right, depending on the time of the market. So with the BMN2, you pay up front, so you're not dealing with the situation where people renegotiate the price partway through. It certainly happens. People will start you on a contract, and if you read the fine print, they can change the price, basically.
And one clarifying question is to follow up on that. In terms of units, we're seeing an interesting world where we have Bitmain putting out the most efficient, most powerful units ever. There's a treadmill every 6 months or something else. The costs are, in that $15 to $20 per terahash, depending on the sort of unit. How are you guys thinking about purchasing units right now for these nodes? Are you purposely going out and purchasing new units because you want to have the longevity of these things for like the next 2 years? Or are you guys trying to play that kind of cheaper game like the core scientifics of the world, where they're willing to take less efficient units in order to keep the capex down?
Yeah, I mean, I think actually, because people who are in mining in a big way, prop mining or providing hash rate, are doing a lot of modeling about this, and it's a very interesting trade-off. So Core Scientific is not missing a trick there. That is definitely one way to go, which is to buy cheaper miners, and then you don't have much capital outlay to overcome, because that capital outlay could have gone into mining more Bitcoin, right? But then your power bill will be higher. So, there are ways to combat the power bill, which is you underclock them, or you use a higher curtailment. So it's a bit of a mix. Historically, we've mined all the different major manufacturers and brands because we're hosting other people's miners. And sometimes they will ask us for, to negotiate a price for them with the manufacturers or make a recommendation. But other times they've already bought the miners, right? So it'll be what they've bought. For ourselves, we quite like the MicroBT equipment. Just find it a little bit more compact, so you can fit more miners in a container format, and it seems to be a bit more robust in terms of tolerating the heat than the Bitmain models. So, when you're looking at your overall cost of operations, there are more factors than just the cost of the miner. For example, if you buy slightly cheap, a new miner that's slightly cheaper or slightly more efficient, but it uses up more physical space, or you have to cool it more aggressively because it doesn't tolerate heat as well. That will, you might lose that efficiency in other places, right? So, yeah, and I think the other strategy you see some public mining companies do, and we talk about the public ones because they disclose what they do, right? The private companies are not always talking about their strategy, is to replace the miners. So, the miners at Core Scientific may be buying, some of them may be coming from other miners who bought new miners, right? So there are people who are sort of playing the market, but deciding when to sell, part of their current fleet and upgrade it, right? So, and that's, they're going to upgrade it with something more efficient, right? But the question is, with the efficiency game, do you start, with the latest and greatest, or do you start at the midpoint and then upgrade the midpoint later? So, I mean, we're not, committing to do anything specific, right? We'll play it by ear, and we have our own models, but that's generally what people are up to. Some range of things like that.
So one last question from me, Adam. There are a few differences between the way that the first note was structured and the way that the second note is structured. For instance, second note has a longer duration, also has a larger equipment failure buffer. First was 10%, the second was 50%. What were some of the lessons learned from the first note that y'all tried to apply to this second one?
Well, I think the reason there was a 10% on the first one is we didn't want people to be concerned about and creating support tickets about, under delivery. So we bought 10% more, literally bought 10% more machines. And in that, with the BMN1, we bought a specific miner model of MicroBT, right? Or a couple of models. And within the contract was the right to, swap it, upgrade it with something as good or better, right? So because they're brand new machines, we assumed the failure rate would be low. But here we're taking a more adaptive view, like, you mentioned Core Scientific and some other public mining companies who've been in the prop mining space for a while too, that, we may swap miners at different points in the time. So, we figured that as we have our own prop mining fleet, we can draw from that if there's an outage, or if there's a batch of machines that fail or something like that. So we just provided a higher buffer because it's not a specific brand new miner that we might be mining at any given time, right? Because when you make these products, you have to contemplate what's going to happen over a long period of time. So generally, you want a bit of flexibility to do, the right thing for keeping the hash rate online, delivering what people are expecting, the 1 petahash, and keeping our internal costs low. If you tie yourself into something and that works out to be uneconomical, that won't be good for anybody. So generally, I think the lesson there is like a bit more flexibility because people are getting more sophisticated about how they manage fleets. And then the other difference you mentioned is the duration. So 3 years was a good duration, but the Bitcoin halving cycle is 4 years. So we figure, well, let's give people a full cycle. And I think, the other aspect we didn't mention about the BMN is that it pays out a term, right? So, and if you have a mining product that is paying in real time to a pool account or paying you a dividend every month or every quarter, the residual value of the unit will be falling. And that's not good for miner, for investor psychology, that you buy something and its value is falling. And of course, you're getting dividended. And the other thing is we figured that it's going to give you a better economic return if you hold and you don't sell the coins. And the temptation you have with people when they're receiving, Bitcoins every day on a pool or, every quarter a dividend is they're going to sell the Bitcoins. And so we want to encourage them to hold the Bitcoin. So 4 years is a nice duration to be holding where you get the full market cycle experience. And hopefully, as well as you're doing well in Bitcoin returns, you do well from the price, long-term Bitcoin price movement as well. So, you could make a short product, like a 6-month or 12-month product, but I think, we're trying to steer people in a direction that works in our experience. So the main factors we mentioned, don't spend all the money on miners and then sell Bitcoin. That doesn't work out well in our backtesting and prop mining experience. Keep the Bitcoins over a long period, like 4 years. Don't sell them as you go. And so that's what we packaged into it.
Awesome. Well, I think that's a good place to end it. Pretty in-depth review of this product for Bitcoin mining. Adam, thank you for joining us. Any final thoughts before we jump off the line here, or anything you want to get out to listeners before so?
Yeah, I mean, I think, one way to look at mining is discounted dollar cost averaging. And, if you look at this series, it's quite aggressively priced. You're getting $21 per hash day, and you can look at the hash price somewhere in the 38 to 40 range. It's Bitcoin price moving around. And with the following series, because we sell more tranches over time, the price won't, the price will be more dictated by the market, and so it's likely to cost more ultimately.
Gotcha. Perfect. Well, Adam, thank you again for joining. I think everyone follows you on Twitter already. So, but we'll link that in the show notes, and then of course Blockstream as well. So we'll see you again here on the show, I'm sure. And best of luck with Mining Note and mining during like these historic low hash price season. We'll see you here soon. Thanks, Adam.
Thanks, Adam.
Thanks.
Okay, Colin, we just wrapped up the interview with Adam, and I thought we could do a rare post-interview digest because, one, there's both of us here today for that interview, and two, that was a pretty confusing topic if you're not familiar with the ins and outs of Bitcoin and Bitcoin mining. But it's really important because a lot of people want exposure to Bitcoin mining through some sort of investment vehicle, and there's a lot out there, whether you are buying shares on a public Bitcoin miner, whether you're going through like the hosted route, say with like a Compass or a Simple Mining or one of those alternatives, or you can go purchase some of these like financial instruments as well. And then the last case, of course, is just go buy Bitcoin and say like, hey, we're all long Bitcoin. You could self-mine if you want as well, but it's not great for a lot of people. This note is really interesting, and their first note did well. I thought the conversation was pretty solid, but it is hard to understand some of these things. So I want to chat with you about it.
Chunks to digest.
A lot in there.
That's why I tried to back up after the first few questions, because to contextualize this whole thing, you have to understand a few moving parts within the Bitcoin mining industry. But the basic concept for any who are still feeling lost after the podcast, hopefully you're not, is you pay Blockstream for the Bitcoin mining note. The mining note represents a unit of hash rate, and then it also represents payouts from that unit of hash rate over a lockup period for your duration for this. There are a few threads that I want to kind of just pull on because I think that they're really important for understanding the current mining landscape, and specifically this concept of financializing hash rate. When Blockstream launched this node in 2021, there were very few instruments that represented hash rate derivatives. Luxor was still working on its hash rate forwards. Now Luxor has their forwards. They also have their futures. There are a lot of new financialization tools out there for hash rate. And this is kind of in the broader conversation with them. And I think the most important thing potentially to pull out of this is just this idea that now there is so much liquidity for these derivatives, for Blockstream's Bitcoin mining note to some of Luxor's products to other players in the space, that you now have enough arbitrage opportunities to where we should see these kind of instruments converge on a single market price. Obviously, it's not going to be a uniform market price, but all of these things trade based on hash price. So you should see, the market kind of reach a consensus on what all of these things are worth across all of these disparate markets. And to highlight that a little bit further, I think one of the coolest things about this is that it is tradable on a secondary market. So you're not locked up and you're not married to the rate that you're getting from Blockstream. You can then go, if you can find other sellers, either OTC and peer-to-peer, or on some of these secondary markets that Adam mentioned, then you can really trade this thing real time with hash price. I think that's really interesting. As our friends at Luxor wrote in a hash rate index article, specifically Khan Ferrani, he mentioned in the article that the trading volume last round was on the secondary market was very small. Blockstream estimates maybe 20 million. They sold roughly 50 million of the Bitcoin mining note the first go around. It would be really interesting, I think, to run those numbers after this one to see how much secondary market trading has taken off. There are obviously a lot of factors here. I'd almost imagine that you would see maybe more activity this go around because hash price is extremely low and the margins here are going to be lower than they were last time, because to contextualize the first note, they launched it right before China's mining ban, which then, basically created this cascading event for Bitcoin's hash rate. Difficulty dropped, Bitcoin hash price soared, and miners were just rolling in it for a few months. So the timing of the last one was super interesting on the bullish case. This one is kind of coming in on a more bearish case. So it'll be interesting to see how that trading on the secondary market evolves as we go forward over the next 4 years in this halving epoch. But what takeaways did you have from the conversation? What stood out to you?
I think like there's a bunch of things we didn't ask that are kind of hard to ask because it's such a tough topic in the first place. We spent a lot of time in the conversation explaining what this kind of note is in the first place. And they might not even call it a note, but I'm going to call it a financial note just for simplicity. One, the China mining ban, that definitely helped out the first note, right? Difficulty dropped quite a bit. And if you were mining during that period, then you had just a really good little bonus period for Bitcoin mining that helped out the margin with that first note. And so will we see that with the second note? It seems very unlikely. I don't see like a lot of headwinds. There's not a huge concentration of hash rate that can be banned at a moment's notice. I mean, the largest concentration of hash rate is probably like in Texas or the southeast of the United States at this point, and just the rule of law doesn't allow for those sort of things. So even if, say, Russia or somewhere else bans Bitcoin mining, like, you know how much Bitcoin hash rate would drop because it's just the straight on percentage. Russia banned it, be 10% of the network because there's like 10% there. Those are approximations, of course, and doesn't look like Russia's going to happen. Yeah, Russia's like legalizing it.
Yeah, the oligarchy over there has too many. It has too many fingers in the state, so they're just not gonna. That's probably not going to happen. Never say never, but
never say never. But that was one thing I think that just to grade ourselves, we should have asked about that, and I think that's just a thing for investors to look at this. The other thing I'd say is like, you know, these sort of hosting operations of history of not doing so well, and I know with Texas Bitcoin mining and Quebec Bitcoin mining, there's some questions about that. I think pressing them a little bit more on like the all-in cost would be good because yes, if your base case is $21 per petahash, then you have a little bit to go down before you're mining the negative. And I don't know if we're going to go down much more. I think a lot of people who are modeling these things out think that $40 is actually kind of our base case. But you know, there are things that can happen to your own operation that can cause it to happen. So it's not just Bitcoin mining that the hash price goes down. It's like your own operation. You could have a new tax pop up in Quebec. You could have some sort of difficulty with your mining operation. You could get rigs that are more expensive than you thought. You could have a DOA rate on your rigs. There's just like a lot of different considerations on the site by site cost. So I'd say like site by site hash price as opposed to network hash price. And for this note, I'd say like just be careful to think about that before investing in something like this, because there are a history of hosting providers offering things like this, and then their site has an issue, and your hash price is very different than the network hash price. So those are some things I thought about. The last thing is, you know, I would say that there is a history of a lot of announcements from Blockstream mining that we haven't heard an update from.
Yeah, we didn't talk about the Tesla thing.
Yeah, and there's like a Tesla announcement from 2021 where they're mining Bitcoin. Never heard about that again. And it's just, some of those things make me a little bit uneasy. So I'd be curious to know more about that, which it's unfair to bring up later because we didn't ask them about it in the show, but it is there.
Right, it is. It maybe is a little bit unfair, but I would say, you know, the BMN, for the first note was a success.
Very big success.
Investors were paid out. The other thing interesting too, going back to downtime within the farms that are operating, it is interesting that the buffer rate for the ASICs on this node are 50%. So they're over allocating for how many ASICs they want to have operating based on how many notes they are issuing. I think that is an interesting data point considering the first was 10%. So they're being very cautious here. I think that should give some investors some confidence. And the last thing I just wanted to pull out of what you just said, you were talking about what could happen this go around that would be positive for hash price in either direction. You know, talking about the China mining ban, there probably won't be anything like that over this epoch. At least we don't think so. Maybe there will be a similar black swan. But the fact that they're setting the price for this one at, I think, what is it, $22 per petahash per day is really interesting because that implies that they believe that the floor for hash price this cycle will be just a little bit above that. Because they're not going to sell this note, they're not going to sell their production forward without having the assurance that they are going to be able to make a little bit more than what they're selling it for, right? So the last time it was like the implied rate was like $99 per petahash per day, I think, for the contract. So as Adam said in the interview, he even mentioned it. He said, I don't see network hash rate necessarily doubling over any meaningful time period when we have this note live, because of so many constraints, from energy constraints to manufacturing constraints to hash price constraints. So that supply and demand factor between how much supply can the Bitcoin mining network provide versus the demand for that hash rate is interesting, because it's implying that that floor is probably just above how much they're issuing this note for, how much the lockup is, $20 per petahash per day. So, it almost seems to imply that they think we've hit a bottom, or the bottom is not too far below where we are right now.
So I think there's some good critiques that we can pull out, and that's why we're doing the digest afterwards, because I think the conversation just got pretty technical with the financial instrument itself. But it's an interesting product. Go check out the Luxor piece. We'll link it in today's show notes. That's a good breakdown of the last note and the future note. And then there's some good information on the Blockstream website about the node as well. So there's all that. Of course, this is not financial advice. This is for educational purposes only. Colin, I think we can close out there. Thanks for joining the show. We will see you guys later this week for the Bitcoin Mining Stock Show. That's a new live stream on Wednesdays where we talk about Bitcoin stocks, not just Bitcoin mining stocks, but Bitcoin stocks. And then, of course, our news roundup at the end of the week. See you guys later.